Hello, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're digging into a question that's on the mind of every serious investor, especially those of you watching inflation, global conflict, and interest rate changes like a hawk. That question is gold still a safe haven in 2025? Is it still worth allocating a part of your portfolio to shiny metals like gold and silver? Or has the digital era and the rise of new asset classes changed the game for good? Let's dive deep into the topic, explore its cultural, historical, and economic roots, and see where gold stands today. And for those of you wondering how to get started with commodities, I've got some practical tips and tools that can help, including a couple of resources you'll definitely want to bookmark. So, let's start with a basic but crucial question. What is a safe haven asset? A safe haven is something you turn to when everything else feels risky, a financial lifeboat. It's an investment that's expected to hold or increase its value when markets are in turmoil. And for centuries, gold has been that go-to lifeboat. We've seen it during financial meltdowns, during wars, during inflation spikes. When the world panics, gold typically rises. Why? Because it's physical, it's finite, and it's trusted. That combination is rare. Sure, there are other safe haven assets, US, treasuries, the Swiss franc, maybe certain utility stocks, but gold holds a uniquely global appeal. Now let's compare gold to stocks. This is where the discussion really starts to split, especially for those asking, buying gold or stocks, which is better? Gold and stocks serve different purposes. Stocks are about growth and income. You buy Apple, Tesla, or Microsoft because you expect them to make more money over time. Gold, on the other hand, doesn't generate income. It doesn't pay dividends. What it does is preserve value. During major financial crises, like the 2008 crash or the pandemic meltdown in 2020, stocks took a hit while gold surged. Historically, they've had an inverse relationship. And that's why gold is often seen as a hedge, a safety net. But let's not ignore this. Over long-term bull markets, stocks outperform. Between 2009 and 2019, the S&P 500 rose over 300%. Gold, around 40%. That's a huge gap. So if you're in a growth market with a long horizon and can tolerate risk, stocks may be better. But if you're in a rocky period or nearing retirement, gold's defensive power is unmatched. Okay, so maybe now you're thinking, how do I even invest in gold or commodities if I'm just getting started? Great question. Here are the main routes. Physical gold, bars, coins, jewelry. This appeals to many culturally, but comes with storage and insurance concerns. ETFs, like GLD or SLV, super easy to buy and sell, no vault required. Mining stocks. These are more volatile but can offer big returns when gold prices rise. Futures and options. This is for experienced traders who understand leverage and margin. For beginners, I always recommend starting with platforms that are easy to use, educational, and safe. One that fits the bill is crystalballmarkets.com. They offer metals margin trading with a beginner-friendly interface and low barriers to entry. It's a great resource if you're exploring how to invest in commodities for beginners. Now let's shift gears and talk silver, the underestimated cousin of gold. Silver is a unique hybrid. It's both a precious metal and an industrial metal. You'll find silver in electronics, solar panels, and emerging green tech. As governments invest more in clean energy, silver demand is growing. It's more volatile than gold, so it carries more risk but also offers bigger upside. And like gold, it holds up well in inflationary times. A portfolio with both metals allows you to hedge against economic downturns while also riding industrial growth trends. Let's zoom in on something that rarely gets enough attention, the cultural connection to gold. In Asia and the Middle East, gold isn't just an investment, it's heritage. In India, for example, gold is central to weddings, religious festivals, and long-term saving. Families buy gold jewelry not for fashion, but as financial security. In the Middle East, gold is often passed down through generations. It's a status symbol and a legacy asset. These cultural behaviors translate into steady demand that supports gold prices. This explains why many investors in these regions stick with gold, even when newer assets like crypto come along. So, how does gold fit into a modern portfolio? Even today, most advisors recommend 5 to 10% in gold or precious metals. Why? Because it reduces volatility. It hedges against inflation and acts as a counterbalance to market crashes. And this isn't just for small investors. Central banks and sovereign wealth funds also hold gold for the same reason. It's not about aggressive returns, it's about protection. Think of it like financial insurance. You hope you won't need it, but when you do, it's invaluable. We can't talk about gold without mentioning the rise of alternative investments in 2025. Investing isn't just stocks and bonds anymore. We've got real estate, REITs, crypto, private equity, and of course, commodities. To help make sense of it all, check out the Crystal Ball Markets podcast. They break down trends like commodity investing explained simple, futures options basics, and even REIT investing podcast episodes that explain how to navigate today's diversified market. It's beginner friendly but deep enough for serious learners. Let's talk futures. Gold futures allow traders to speculate on or hedge against future price movements. These contracts are powerful but complex. They require understanding of margin, expiration, and risk management. Used correctly, they offer precision and leverage. For example, if you're managing currency risk or preparing for geopolitical shock, gold futures can protect your position. But, and it's a big but, misuse can lead to serious losses. That's why education is critical if you're dabbling in oil trading for beginners or exploring futures options basics. Always start with platforms that support structured learning. And finally, let's touch on the digital transformation of commodities trading. Thanks to technology, retail investors now have access to tools once reserved for institutions. Mobile platforms, real-time data, and even blockchain-based gold tokens have made it easier than ever to invest. Tokenized gold, where each digital token is backed by physical gold in a vault, offers liquidity and accessibility. But even as these innovations take off, traditional physical gold retains its charm. When things get shaky, when banks wobble, when crypto stumbles, people want something real they can hold. So, when does gold make the most sense? During inflationary cycles, during market crashes, when geopolitical instability spikes, in high debt economies, when you want to pass wealth down generationally. But gold isn't magic. It won't help in a booming bull market the way stocks or crypto might. It doesn't pay income. What it does is stabilize. All right, final thoughts. Is gold still a safe haven? Yes, but it's not the only one anymore. It should be part of a balanced strategy, not the whole plan. As we move through 2025, gold still serves the same role it always has, grounding your portfolio. In a fast-changing world, that kind of timeless value still matters. If you want to learn more or start trading metals yourself, visit crystalballmarkets.com. And if you're serious about becoming a smarter trader, check out the Crystal Ball Markets podcast. I highly recommend it. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll catch you in the next episode. Until then, trade smart, stay informed, and never stop learning.